Trump just blocked 6 oil tankers in the Caribbean. This is not about Venezuela. This is about fundamentally altering how international commerce operates. Every major oil trader on the planet is now looking at their payment systems differently. When you cannot move oil through traditional channels, you create new channels. And those new channels are demanding physical silver as collateral. The 6th tanker seizure happened Thursday morning. The Veronica, Coast Guard tactical teams boarded at dawn. No resistance. Clean operation. But the implications are anything but clean. Because this is not law enforcement. This is economic warfare. And the target is not just Venezuela. The target is every country that still believes they can conduct international trade without American approval. January 3rd marked the beginning. Operation Absolute Resolve captured Maduro. But that was theater. The real operation started 3 days later when Trump announced the complete blockade of sanctioned vessels. Not just Venezuelan vessels, any vessel that had been in Venezuelan waters, any vessel carrying Venezuelan crude, any vessel financed by Venezuelan entities. The definition keeps expanding, the net keeps widening, and the global shipping industry is starting to understand what Trump is actually doing. He's forcing a choice. You can either trade through the American system under American rules with American oversight, or you can trade outside the American system. But if you choose to trade outside, you need a new form of collateral. You need something that cannot be frozen by American authorities. You need something that cannot be seized by the Coast Guard. You need something physical. The numbers are staggering. Global oil trade moves approximately $2.1 trillion annually through spot markets and long-term contracts. When Trump blocks tankers, when he seizes vessels, when he declares quarantines, he is not just affecting Venezuelan oil. He is affecting the entire flow of petroleum products across the Caribbean, through the Gulf of Mexico, and into the Atlantic shipping lanes. Major oil trading houses are already adapting. Vitol, Trafigura, Glencore. These are the companies that control global energy flows. They have been quietly restructuring their operations. Instead of relying solely on dollar-denominated letters of credit, they are now accepting physical precious metals as guarantees, silver specifically, because silver is industrial, because silver is needed for the energy transition, because silver cannot be printed or seized or frozen. The implications go far beyond oil. Every international commodity trader is watching, grain traders, copper traders, steel traders. They're all asking the same question. If Trump can block oil tankers, what stops him from blocking grain shipments? What stops him from seizing copper vessels? What stops him from quarantining any ship that does business with countries America disapproves of? The answer is nothing. There is no legal framework that limits Trump's authority here. The International Emergency Economic Powers Act gives the president broad discretion to regulate international commerce during declared emergencies. And Trump has been very clear. The emergency is ongoing. The threats are multiplying. The scope of American intervention is expanding. This is why physical silver is exploding. Not because of industrial demand, not because of mining shortages, because of payment system fragmentation. When traditional banking channels become unreliable, when SWIFT transfers can be blocked, when correspondent banking relationships can be severed, traders need alternatives. And the most reliable alternative is physical collateral. Consider the mechanics. A European refinery wants to buy crude oil from a Middle Eastern producer. Normally, this transaction would be settled through dollar-denominated wire transfers. The refinery would send dollars to the producer's account. The producer would load oil onto a tanker. The tanker would deliver to Europe. Simple, clean, efficient. But what if that crude oil transited through Caribbean waters? What if the tanker had previously stopped in Venezuelan ports? What if the trading company had financial connections to sanctioned entities? Suddenly, the transaction becomes risky. The tanker might be seized, the dollars might be frozen, the entire trade could be disrupted. So the parties find new methods. The European refinery deposits silver bars in a Swiss vault. The Middle Eastern producer receives title to those silver bars upon delivery of the oil. No dollar transfers, no SWIFT messages, no American banking system involvement, physical delivery of commodities secured by physical collateral. This is not theoretical, this is happening right now. The London Metal Exchange has seen unprecedented activity in silver warehousing. Physical silver deposits in Swiss vaults have increased by 340% in the past 2 weeks. Singapore's precious metals storage facilities are at capacity. The infrastructure for silver-backed international trade is being built in real time. The banking sector understands the implications. JP Morgan Chase has quietly increased their physical silver holdings by an estimated 200 million ounces since the Venezuela operation began. They are not doing this for speculation. They are doing this for client services. Their institutional customers are demanding access to physical silver for trade settlement purposes. But there is a problem. The available supply of investment-grade silver is not infinite. Global above-ground silver stocks, suitable for commercial trading, total approximately 2.5 billion ounces. If even 5% of international commodity trade migrates to silver collateral, You are looking at demand for 500 million ounces annually. The mining industry produces about 800 million ounces per year, but 600 million ounces go to industrial applications. The math does not work. This is the supply crisis that most analysts are missing. They focus on industrial demand from solar panels and electronics. They focus on investment demand from retail buyers and ETFs, but they ignore settlement demand from international trade. And settlement demand is about to become the dominant factor in silver pricing. The Federal Reserve sees this coming. They understand that Trump's blockade strategy is accelerating the fragmentation of the global financial system. Countries and companies are finding ways to trade that bypass American oversight. And many of those ways involve physical commodities as money. This terrifies central banks. Because if silver becomes the preferred medium for international trade settlement, if physical precious metals replace digital dollars in commercial transactions, then the Federal Reserve loses control over global liquidity. They cannot print silver. They cannot manipulate silver interest rates. They cannot use silver as a tool of foreign policy. So they have two choices. They can fight the trend by increasing the pressure on alternative payment systems. More sanctions, more seizures, more financial warfare. Or they can accommodate the trend by allowing silver to appreciate to levels that make the new system function efficiently. The first option leads to further fragmentation. More countries seeking alternatives to dollar-based trade. More companies building precious metals infrastructure. More pressure on physical silver supplies. The second option leads to controlled devaluation of the dollar against hard assets. Higher gold prices, higher silver prices, but maintained American influence over global finance. The question is which path Trump chooses. And the answer appears to be both. Maximum pressure on adversaries combined with accommodation for allies. Countries that comply with American trade policies continue to access dollar-based systems. Countries that resist face blockades, sanctions, and forced migration to alternative systems. This is economic bifurcation. Two separate trading blocks. One denominated in dollars and controlled by America, one denominated in physical commodities and controlled by no single nation. And the commodity block is growing faster than the dollar block because physical assets offer genuine sovereignty. The timeline is accelerating. Each tanker seizure forces more traders into alternative systems. Each new sanction pushes more transactions toward physical settlement. Each expansion of American financial enforcement creates more demand for silver as trade money. We are not talking about years. We are talking about months, maybe weeks. The infrastructure exists, the demand exists, the precedent exists. The only missing piece is widespread recognition that the old system is breaking down and the new system is already here. Silver prices reflect this transition, not gradually, violently, because the shift from paper-based trade settlement to physical-based trade settlement is not smooth. It is discontinuous. Markets that functioned with digital payments suddenly need physical collateral. The demand appears overnight. The supply takes years to develop. This is the squeeze. Not manipulation by banks, not speculation by retail investors. Settlement demand from international commerce, the most powerful and persistent form of commodity demand in existence. Trump's tanker seizures are not law enforcement operations. They are system transformation operations. And the system they are creating requires physical silver, not as investment. As money, the $2.1 trillion in global oil trade is just the beginning. Grain trade, metal trade, chemical trade. Every form of international commerce that currently depends on dollar-based settlement is evaluating alternatives. And every alternative points toward physical precious metals. The game is not over. The game is changing. And silver is the new rulebook. Think about the cascade effects. When major oil trading houses start demanding silver collateral, their suppliers need silver. When suppliers need silver, they compete with industrial users. When industrial users cannot get silver at previous prices, they raise their product prices. When product prices rise, inflation accelerates. When inflation accelerates, central banks lose credibility. But this inflation is different. It is not monetary inflation caused by money printing. It is scarcity inflation caused by supply chain restructuring. You cannot solve it by raising interest rates. You cannot solve it by reducing government spending. You can only solve it by increasing silver production or reducing silver demand. And production takes years to expand while demand is exploding now. The feedback loops are vicious. Higher silver prices make alternative payment systems more expensive. But they also make those systems more attractive because they offer true independence from American financial control. Countries that want sovereignty are willing to pay premium prices for silver-backed trade settlement. China understands this dynamic perfectly. They have been accumulating physical silver for months, not for industrial use, for monetary use. They see Trump's tanker seizures as an opportunity to accelerate the development of dollar-independent trading systems. Every ounce of silver they control is leverage in the new economic order. Russia is following the same strategy. Despite sanctions, despite asset freezes, despite international isolation, they continue mining silver. They continue refining silver. They continue stockpiling silver. because they know that physical silver is the path back to international commerce. Not through American systems, around American systems. The Middle Eastern oil producers are the wild card. They have been selling oil for dollars for 50 years. The petrodollar system made them wealthy beyond measure. But wealth means nothing if it can be seized by American authorities, if their tankers can be blocked by American naval forces, if their payments can be frozen by American banks. So they are quietly diversifying, not into other fiat currencies, into physical assets, gold for store of value, silver for trade settlement, copper for industrial hedge, real assets that cannot be printed or seized or manipulated by foreign governments. This diversification is accelerating the very crisis Trump is trying to prevent. American financial dominance depended on other countries having no alternatives to dollar-based systems. But by making those systems unreliable, by seizing assets and blocking trades and imposing sanctions, America is forcing the creation of alternatives. The alternatives exist now: Swiss vaults accepting silver deposits, Singapore exchanges clearing silver trades, London markets financing silver shipments. The infrastructure for silver-based international commerce is operational, not experimental, operational. Trump's next move determines everything. Does he escalate the blockade strategy? Does he seize more tankers? Does he expand the definition of sanctioned vessels? If so, more trade migrates to alternative systems. More demand flows into silver. More pressure builds on physical supply. Or does he pivot toward accommodation? Does he offer pathways back into dollar-based systems? Does he reduce sanctions in exchange for compliance? If so, the pressure on silver moderates. But American credibility remains damaged. The precedent of seizure and blockade remains established. Either path leads to higher silver prices. Escalation through supply shortage. Accommodation through currency debasement. The question is not whether silver rises. The question is how fast and how far. The banking sector is positioning for both scenarios. Long silver positions for supply shortage protection, long mining stocks for production expansion exposure, long storage companies for infrastructure demand. They are hedging against systemic change by betting on the assets that benefit from systemic change. This is not speculation. This is portfolio insurance. Insurance against the breakdown of the global financial architecture that has existed since 1971. Insurance against the emergence of new trading systems based on physical commodities rather than fiat currencies. The insurance is expensive now. Silver at current prices requires significant capital commitment. But the alternative is catastrophic portfolio loss if the dollar-based system fragments beyond repair. No prudent institution can ignore that risk. Retail investors are still catching up. They see silver prices rising and assume it is just another commodity rally. They see precious metals outperforming stocks and assume it is just inflation hedging. They do not understand that the fundamental nature of money is changing, that physical assets are becoming trade settlement instruments. When they understand, the demand will overwhelm available supply immediately, not gradually over years, immediately over weeks, because the total value of retail investment assets far exceeds the total value of available silver. If even a small percentage of retirement accounts and investment portfolios rotate into silver, the price must rise dramatically to ration the limited supply. The ratio mathematics are brutal. Global financial assets total approximately $400 trillion. Available investment silver totals approximately $50 billion at current prices. If 1/4% of financial assets rotates into silver, you need $1 trillion of silver. At current supply levels, that implies prices above $500 per ounce. These are not predictions, these are calculations, based on known supply constraints and observable demand patterns. The migration toward silver-based trade settlement is measurable. The infrastructure development is documented. The institutional positioning is public information for companies that file disclosure statements. What remains unknown is timing. How long before the cascade begins? How long before retail demand amplifies institutional demand? How long before supply shortages become acute enough to force dramatic price adjustments? The answer depends on Trump's next actions. More tanker seizures accelerate the timeline. More sanctions expand the affected markets. More financial warfare drives more participants toward alternative systems. But even without additional escalation, the trend is established. International trade is restructuring around physical collateral. Silver is the preferred collateral for energy trades. Energy trades are the foundation of global commerce. The mathematical progression is inexorable. More energy trades require more silver. More silver demand meets fixed silver supply. Fixed supply meeting exponential demand produces exponential prices. This is not market manipulation. This is not speculative bubble. This is structural transformation of the global monetary system. And structural transformations create permanent demand for the assets that function as money in the new structure. Silver is that asset, not by choice, by mathematical necessity. The available supply of other precious metals is too small to handle international trade volumes. The available supply of industrial metals is too committed to manufacturing uses. Silver is the only metal with sufficient above-ground stocks and suitable physical properties to serve as large-scale trade settlement medium. The market is beginning to understand this reality, not quickly, not smoothly, but inevitably. Each day brings more evidence that traditional payment systems are fragmenting. Each week brings more infrastructure development for alternative systems. Each month brings more institutional adoption of silver-based trade finance. The accumulation phase is ending. The recognition phase is beginning. And when recognition becomes widespread, when the mathematical constraints become obvious to all market participants, the price adjustment will be swift and decisive. Trump's tanker seizures are not creating this dynamic. They are accelerating this dynamic. The underlying forces were already in motion. The retreat from dollar dependence, the search for payment alternatives, the infrastructure development for commodity-based trade. But acceleration matters because it compresses timeline, because it creates urgency, because it forces immediate decisions rather than gradual transitions. The immediate decision facing every international trader is simple. Continue relying on systems that can be blocked, seized, and frozen, or migrate to systems based on physical assets that cannot be controlled by any single government. The smart money is already migrating. The question is whether you understand what the smart money understands, and whether you position yourself accordingly before the migration becomes a stampede. The precedent is set. American authorities can and will seize foreign vessels engaged in trade Washington disapproves of. This is not limited to Venezuela. This is not limited to sanctioned countries. Any vessel that has touched sanctioned waters, carried sanctioned cargo, or been financed by sanctioned entities becomes subject to seizure. The definition of sanctioned expands daily. Today, it is Venezuela. Tomorrow, it could be Iran. Next week, it could be any country that refuses to accept American trade demands. The net keeps widening. The risks keep multiplying. The alternatives become more necessary. But alternatives require infrastructure. You cannot replace a global payment system overnight. You need vaults to store collateral. You need assay services to verify purity. You need transportation networks to move physical assets. You need legal frameworks to enforce contracts. You need insurance coverage to protect against loss. This infrastructure exists for silver. Centuries of precious metals trading have created sophisticated systems for storage, transport, verification, and insurance. The London Bullion Market Association sets global standards. The Swiss vaulting industry provides secure storage. The major shipping companies handle physical delivery. The legal precedents exist in multiple jurisdictions. What did not exist until recently was demand. International traders preferred digital payments because they were faster, cheaper, and more convenient. Physical settlement was reserved for specialized transactions involving parties that did not trust each other completely. But trust is no longer the issue. Control is the issue. When your digital payments can be blocked by foreign governments, when your bank accounts can be frozen without warning, when your trade finance can be severed at any time, physical settlement becomes the more reliable option, despite higher costs and longer settlement times. The cost differential is shrinking anyway. Digital payments are becoming more expensive as compliance requirements multiply. Know your customer investigations, anti-money laundering reviews, sanctions screening, transaction monitoring. The bureaucratic overhead of dollar-based payments now exceeds the handling costs of physical silver for many large transactions. And physical silver offers additional benefits beyond payment certainty. It appreciates in value during monetary crises. It provides hedge against currency devaluation. It offers exposure to industrial demand growth. It cannot be hacked or corrupted or accidentally deleted. These benefits explain why sophisticated institutions are accumulating silver beyond their immediate trade finance needs. They are treating it as strategic reserve asset, not just for current transactions, for future transactions under unknown conditions. The unknown conditions are multiplying: trade wars, currency wars, cyber warfare, sanctions regimes, military conflicts. Each form of international tension increases the value of payment systems that cannot be weaponized by hostile governments. Silver-based systems cannot be weaponized because silver is politically neutral. No country controls silver production completely. No government can print silver. No central bank can manipulate silver interest rates. No military can sink silver that is already in your vault. This neutrality becomes more valuable as international tensions escalate. Countries that cannot trust each other can still trust physical silver. They can verify its purity independently. They can store it in neutral jurisdictions. They can trade it without revealing transaction details to foreign intelligence services. The Venezuela operation proves that no digital asset is truly safe from government seizure. But physical silver, stored in neutral vaults, cannot be seized by American authorities, cannot be frozen by American courts, cannot be blocked by American sanctions. This immunity from government interference is worth premium pricing. And premium pricing is exactly what we are seeing in physical silver markets. Not just temporary spikes during crisis periods, sustained structural premiums that reflect the permanent value of government-proof money. The transformation is irreversible. Alternative payment systems once established do not disappear when political tensions ease. Infrastructure once built continues operating regardless of changing government policies. Trust once lost takes decades to rebuild. America may eventually moderate its use of financial weapons. But the countries and companies that built alternative systems will not abandon those systems. They provide genuine independence, true sovereignty, reliable operation under all political conditions. Silver is the foundation of that independence, not as investment speculation, as functional money for international trade, money that cannot be printed, seized, frozen, or manipulated by hostile governments.